Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate jungle, and today we're diving into TransCode Therapeutics' latest filing, which seems to be less of a routine update and more of a let's just say they've been busy. This filing is an amendment, meaning they're correcting or adding information to something they filed before, and it looks like they're adding some crucial financial details after a pretty big deal. We're talking about an acquisition and an investment, and of course all the nitty-gritty that comes with it. Let's peel back the curtain and see what is really going on. So what we have here is an amendment to a previous report, specifically amendment number 3. This just means they've made changes and additions a couple of times since the original filing. The whole purpose is to add in the financial statements and pro forma. That means as if or projected financial information that were missing from their initial report about a big event. The company in question is TransCode Therapeutics Incorporated. They're in the business of biopharmaceuticals, specifically focusing on oncology, which is a fancy way of saying they're trying to use your body's own immune system to fight cancer. Pretty important stuff. You'll see a few boxes here that tell us how this filing is being used. The important one here is that they are using this report to solicit material, basically to communicate with shareholders, as part of a process that might involve them asking for votes or approvals, particularly related to Rule 14 and Negative 12 under the Exchange Act. Their main stock, the common stock, you can find it trading on the Nasdaq Capital Market under the ticker symbol RNAS. This tells us it is a publicly traded company, and therefore they have to report these sorts of things. TransCode Therapeutics Incorporated is an emerging growth company. This means they're relatively new and have some leeway, like using extended transition periods for accounting standards. It is common for newer, smaller companies to be in this category. Now for the core of what this amendment is all about, back on the 8th of October 2025, TransCode Therapeutics Incorporated made a significant move. They acquired 100% of the membership interests in a company called ABCJ, Limited Liability Company. ABCJ is the parent of another company, Polynoma LLC. Polynoma is also a biopharmaceutical company focused on oncology, and it is based in San Diego. So essentially, TransCode Therapeutics Incorporated bought a company that owns another company in the same space. This is what they call an acquisition. Simultaneously with this acquisition, they also entered into an investment agreement with DefJ Limited Liability Company, which seems to be the seller of ABCJ. So it wasn't just a purchase, there was also an investment component. This amendment is here to add the financial disclosures required for such a significant transaction. They're adding information about the acquired company's financials and how the combined company is expected to look financially after all of this. Anytime a company makes a big acquisition or investment, there are risks involved, and this filing lays them out. They caution that there is no guarantee the acquisition will actually increase stockholder value. Integrating two companies is incredibly complex and can lead to management and business disruptions, which could hurt their performance and prospects. One of the major risks they highlight is a contractual repurchase, right? This means the seller, Delaware FJ, has an option to buy back the company TransCode Therapeutics Incorporated just bought. If DefJ exercises this option, TransCode Therapeutics Incorporated would have to sell back the membership interests of ABCJ for the same price they paid. This could seriously impact their stock price, their operations, and their overall financial health. It's like buying a house and the seller having the right to buy it back from you later under certain conditions. Another big concern is around their preferred stock. They have Series A and Series B non-voting convertible preferred stock. If the company fails to deliver the common stock that these preferred shares can convert into, the holders of preferred stock can demand to be paid in cash for the value of that common stock. This could be a massive cash drain. Imagine if a lot of people suddenly asked for cash for their stock that you didn't really budget for. This could leave them short on cash and really hurt their financial situation. It's a serious liquidity risk. They're also warning that stockholders might not see the benefits they expect from this deal, especially considering the dilution. Dilution happens when a company issues more stock, which essentially spreads the ownership pie into smaller slices. A lot of new stock could be issued from converting preferred stock, meaning existing shareholders will own a smaller percentage of the company. If the acquisition doesn't bring in enough value, these shareholders will have less ownership for no real gain. The success of this whole operation hinges on integrating the businesses smoothly. They need to combine operations, policies, and people effectively. If this integration process is delayed or messes up, it could lead to losing key employees, disrupting ongoing business, and generally making things more expensive and less efficient. This could significantly impact their future performance and the value of their stock. Here is a very interesting point. As of the filing date, Delaware FJ holds a significant amount of preferred stock and common stock, giving them about 90.8% of the voting power if all preferred stock is converted. There are rules about how much stock can be converted at once, but after getting shareholder approval, Delaware FJ could potentially convert enough stock to own more than 50% of the voting power. This would make TransCode Therapeutics incorporated a controlled company under NASDAQ rules. As a controlled company, they'd be exempt from some corporate governance rules, like needing a majority of independent directors on their board or having a fully independent compensation committee. It means DEFJ would have a lot of control, which isn't necessarily bad, but it does mean less oversight by independent parties. This concentration of power could also make it harder for any other company to acquire TransCode Therapeutics Incorporated in the future. This acquisition is going to be expensive. They've already spent money and they expect to spend more on integrating Polynoma. This includes merging accounting, HR research and development, and other key functions. These integration costs can be hard to predict and they could lead to significant charges against earnings in the future. The way they account for this acquisition, under US generally accepted accounting principles or GAAP, is important. ABCJ will be treated as the acquired company and TransCode Therapeutics incorporated as the acquirer. The net assets of ABCJ will be recorded at their fair value, not necessarily their book value. Any extra amount paid over the fair value of the net assets will be recorded as goodwill. This accounting process could impact their stockholders' equity, which is a key measure of a company's net worth. If their accounting ends up being significantly different from their initial estimates, it could significantly alter their financial statements. This section is essentially a table of contents for the detailed financial documents they are adding with this amendment. We have the audited financial statements for ABCJ for the past 2 years, their interim financial statements for the first 9 months of this year and last year, and most importantly here, they're providing unaudited pro forma condensed combined financial statements. This is essentially a look at what the combined company's balance sheet and income statements would have looked like if the acquisition and investment had happened earlier. This gives us a snapshot of the potential financial picture of the merged entity. It is important to remember this is hypothetical, not actual historical data for the combined company. And finally, the signature. This report is signed by Thomas A. Fitzgerald, who holds the important titles of Chief Financial Officer and Secretary, dated the 23rd of December, 2025. This confirms the company official is taking responsibility for the accuracy of this filing. So, what does all this mean? TransCode Therapeutics Incorporated has made a significant strategic move by acquiring a complementary company. The intention is clearly to bolster their position in the immuno-oncology space, likely through synergies and expanded capabilities. However, this comes with substantial risks, including integration challenges, potential back clauses, and the financial strain of settling preferred stock. The potential shift to becoming a controlled company under NASDAQ rules is also a major governance consideration, while the pro forma financials offer a glimpse into the potential of the combined entity. Actual results will depend heavily on their ability to execute the integration and overcome the hurdles laid out in the filing. It is a bold play, but one that carries significant uncertainty. Alright, that is our breakdown of TransCode Therapeutics, Incorporated's latest amendment. What is your take on this acquisition and the risks involved? Do you think it is a smart move for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching. See you next time.